Hello, everyone, and welcome to today's class on weighted average cost of capital, also known as WACC. I hope all of you are doing extremely well. So, in this chapter, we are going to basically learn how to calculate the weighted average cost of capital. And as you know, this is very important. Right from the first class, we know that if we want to figure out the value of a company, we need to discount it. We need to discount the free cash flows by using WACC, which is the weighted average cost of capital. So, in this class, since it's financial management class, one of the key things is to learn how to calculate WACC, which this chapter really focuses on. Now, most firms, they have various sources of capital, and capital, as we know, is money that they can use for a number of different projects and just to run their company. And, some of the key sources of capital that companies have is common stock, which can be issued, preferred stock, and debt. And usually people buy stock, or banks are willing to give some sort of a loan to companies because they get some sort of a return, some sort of an interest rate. So the money that is given to companies is not given for free, but people, even stockholders, expect that they get some sort of dividends or returns or capital gains. And similarly, banks expect, they charge an interest rate for short-term loans and for long-term loans. Now, the thing is that what different types of capital, the required return on each different type of capital is different. So the amount of interest rate that is being charged for money that is being loaned to a bank is going to be different from, let's say, the dividends that are being given to stockholders. So if we want to kind of calculate WACC, we need to basically understand the required rate of return for each of the different sources of capital or each component. And this is known as component cost. So long story short, we need to understand, okay, what is the interest rate that the company is paying on debt? What is the interest that they're paying on stock? The different types of stock and so on. So that's very important. And again, the required return on each component is called the component stock. Now, when you take a weighted average of various component costs, that will give you the weighted average cost of capital. So in effect, what you are trying to understand is what is the cost of capital for a company, the cost of, the money that they are taking to run the company or to run projects and so on and so forth. And the weighted average cost of capital is therefore a very important factor to understand. Now, generally speaking, what happens is that companies don't just randomly go and get debt or issue stock and so on and so forth. In fact, they have target percentages for different types of financing sources. And this is known as a target capital structure. So the first thing we're going to talk about in this lecture is the cost of debt. And debt, as you know, is basically, usually people take debt from a bank, okay? So this is the rate of return debt holders require. So, right over here, you can see this R, the subnote D, and this is the amount of return or interest rate that, whoever is giving the debt is charging. Now, the relevant cost that you really need to worry about is not the old debt. So when you're calculating WACC, what is important for you to consider is the marginal cost of new debt that needs to be raised during a planning period. So let's say there is a new project that you are planning to launch in a company. Taking the cost of the old debt that you have is useless. What you will need to figure out is that if you go into the market today, what kind of interest rates are being offered by banks today for the marginal cost, for the additional cost of debt that you will need to take on for the project. And generally speaking, it's hard to figure that out. But one way to figure it out is really to look at the past debt issued or publicly traded debt of similar companies. So again, what you can do is, like, how would you know, right? Like, let's say, for example, you're planning to launch a product in a month's time or 2 months' time. How would you know what the marginal cost of debt is? Well, you can take some sort of an estimate of what the marginal cost of debt is today. That will give you some indication. But also what you can do is you can look at other companies that have taken on debt for similar projects and kind of try to find out what the banks charged them, what kind of interest rate they were charged. To calculate the weighted average cost of capital, as far as the cost of debt goes, you need to take the after-tax cost of debt, right? So here we can see, if this is the cost of debt, you have to take the after-tax cost of debt. And one thing to remember is that when you're calculating, WACC for this purposes, debt flotation costs are generally low or just ignored. So you really don't need to worry about the flotation costs. And, again, the flotation costs are if you are, let's say, about to issue stock, all of those additional costs, you don't need to worry about. The main thing that the focus in the WACC that you will be focusing on is the after-tax cost of debt, right? So that's the interest rate that you will be using when you are calculating the weighted average cost of capital. Okay, next I'm going to talk to you about the cost of preferred stock. So generally there are two kinds of stock. There is preferred stock and then there's common stock. And, I'll just tell you a little bit about the difference in just a second. But let me just start off by telling you that the subscript for this is the cost of preferred stock is shown as R with the subscript of PS. And if you want to figure out what the cost of preferred stock is in terms of, again, we're trying to convert everything in interest rates. Well, here, this is the formula that you would use. And here you would stake your preferred dividend and you would divide it by the preferred stock price multiplied by 1 minus the flotation cost as a percentage of proceeds. Now, so this is an important formula for you to remember. So this is how you calculate the common cost of preferred stock. Now, so, and again, you would be given this information, right? The dividend that's being given on a preferred stock, the preferred stock price, and also the flotation cost. And then you would be able to calculate this value. Usually preferred dividends are paid up before common stock dividends. And it's important to remember that companies have to pay the preferred stock dividends first. And also it is difficult to raise funds in a capital market. So it's not always just, going into a capital market to raise funds is not just a very easy thing to do. It requires a lot of additional money, time, energy, effort. So it's not necessarily the easiest things to do. And also one thing to remember is that in some unique cases, preferred stockholders can actually take control of a firm. So these stockholders are not just the silent ones, but in some cases, they can actually take control of a firm. So again, if you are planning to issue preferred stock, these are just some things to really keep in mind. Okay, next I'm going to talk to you about calculation of common stock. Now, One thing to remember is that when you are calculating the cost of common stock, there are three ways to calculate the cost of common stock. Okay, and I will be talking to you about all three ways. I will explain them to you. But right up front, I want to tell you that again, this R with subscript S, this cost of common stock can be calculated using the CAPM approach, which I'll discuss with you first. It can be used, can be calculated by using the discounted cash flow approach. And finally, it can also be used, also be calculated using the bond yield plus risk premium method. So all three of these I'm going to talk to you about. But before I go into how to calculate it, let me just talk to you a little bit about common stock overall. So companies can raise common stock or common equity by one, issuing new shares. Now, very few companies actually end up doing this because they consider, issuing a lot of new shares as a negative sign in about the true value of a company. So, if a company is constantly issuing a lot of new shares, that gives a kind of a negative image in the market that, look, they're not being able to manage the company. They're regularly just going and having to raise money. Excuse me. Also, another way that companies can raise common stock or common equity is by indirectly reinvesting or retained earnings. So again, companies can basically take their retained earnings and reinvest into the company. And that's just another way of increasing the value of their common equity on their balance sheets. Now, the cost of new equity is RS, is, as I mentioned just a second ago. And this is the amount that firms should earn on its reinvested earnings, at least as much as its stockholders themselves would earn on an alternate investment or equivalent risk. All right, so let me explain this to you. So when you are figuring out, the cost of common stock, it's very important to remember that, look, if a company were to take the money that they have, okay, their retained earnings, and they were to go and into the market and invest that money in any investment investment option that is in the market, then you should be able to earn at least that much. So basically, the cost of common stock has to be equal to basically what they would earn on an alternate investment of equal value. So this is something to really keep in mind. You can, because this will give you a generally good idea of, okay, what the value of RS around about what it should be. Okay, so next I'm going to talk to you about the CAPM approach of calculating R subscript S. Okay, now this equation over here should be relatively familiar to you, because just in the last chapter we kind of covered CAPM and we've seen this equation before. And what is this all about? Well, if you're calculating the RS, or the cost of common stock, using the CAPM approach, what you need to know is the risk-free rate of return. Okay, and that is right over here, the risk-free rate of return. And you also need to calculate the risk premium, right? Expected market risk premium. And what is this? This is basically the expected market return minus the risk-free rate, right? And you also need to estimate the stock's beta coefficient. And then you kind of put everything in the CAPM model, and that will give you the cost of common stock according to the CAPM method. And the risk-free rate in many cases is given as the T-bill rate. Okay, so just something to keep in mind. Now, we've discussed this a little bit, and I'm going to talk to you just a little bit more about it. About the market risk premium. which is what we just kind of right over here, the market risk premium also over here, right? And the market risk premium can be calculated by using historical data, the market risk premiums in the past, and it also can be calculated by forward-looking data, okay? And basically, if you want to calculate the expected rate of return, the formula for that is right over here. So this is the expected rate of return. And here you have now this formula that you're seeing right over here is a little bit different. And the reason is that this formula over here is more to do with the discounted cash flow approach. So over here, you know, we've kind of mentioned in the previous slide and using the CAPM model, we saw that, you know, generally speaking, the market risk premiums, you know, you were given sort of a little bit about what the expected market return was going to be. But sometimes you're not going to be given what the expected market return is going to be. And in that cases, it needs to be calculated. So the discounted cash flow approach gives us a formula to calculate the expected rate of return. And that formula is right over here. And over here, you can see this is the basically what the dividend is expected, what the expected dividend yield is, plus the growth rate, right? So this basically gives you a good understanding of what the expected rate of return is going to be. And here you can see that D stands for dividend and PO is the price of the stock and G is the growth rate, okay? And so the required rate of return is going to be the risk-free rate of return plus the risk premium. And again, the formula is kind of given over here. The range of risk premiums is generally between 3.5 to 6.5%. When you're calculating, you know, beta, and we've discussed that, you know, right in the CAPM, you know, in the previous slide, I just kind of went over that. Now, beta is, you know, as we also saw in the CAPM chapter, beta is difficult to find. It's very difficult to find an accurate value for beta. And generally speaking, it is the slope coefficient in regression. So when you regress stock returns on the y-axis and market returns on the x-axis, that's how you basically generate the beta values. And because it's hard to find an accurate beta value, it's very difficult to calculate very accurate CAPM values. And also it's very difficult to calculate market risk premiums. And that's why in some cases, the discounted cash flow approach is used. So I'm now going to tell you a little bit more, you know, about the discounted cash flow approach. And here you can see some formulas. And the first formula is how to calculate the price of stock. So again, if you want to calculate, and remember that what we're trying to do is calculate the cost of common stock using the discounted cash flow approach. Well, if you want to use this formula, then you have to basically know what the price of the stock is. And in order to calculate the price of the stock, you can use this formula over here. A lot of this information is generally going to be given to you in the questions that you will be solving. One thing to mention is that it is hard to calculate, to basically have a good estimate of the growth rate. And so this is just something to keep in mind. And again, what we're talking about here is the growth rate of the dividend yield. So one way to estimate the growth rate is basically which is difficult, as I just mentioned, hard to estimate, is to basically take an ROE and multiply it by the retention ratio. And however, this model does have a lot of assumptions, and the retention ratio is basically 1 minus the payout ratio. And the payout ratio is basically the percentage of net income that the firm pays out as dividend. So generally speaking, analyst forecasts can be used to estimate the growth rate, or G, and also people also look at historical growth rates when they're estimating the value of the growth rate of the dividend yield. So next, I'm going to talk to you about yet another approach or another method to calculate RS, or the cost of common stock, and that is the bond yield risk premium approach. And according to this, basically what you do is this is right here. This is the formula given right over here. And so what you really need to figure out here is there are two components here. If you want to calculate the bond yield premium approach, you have to take the bond yield and add the bond risk premium right over here, given it right over here, right? So that's how you basically can calculate it. And what is the bond yield? Well, the bond yield is basically the interest rate on the firm's long-term debt. And that's something to remember. Generally speaking, the bond risk premium is between 3 to 5%. And it's a judgmental risk premium. So again, it's not necessarily very specific, but what you're looking at is you're taking your long-term debt interest rate and you're adding a certain percentage to it. And that gives you the bond yield risk premium approach of calculating the cost of common stock. So again, we just sort of saw that the cost of common stock can be calculated using the CAPM approach, which we had learned in the CAPM chapter, so we were kind of familiar with it. We introduced the discounted cash flow approach, and in that you sort of saw that dividend yields and expected growth rates were used to calculate the cost of common stock. And right now we just sort of saw that bond yields can also be used to calculate the cost of common stock. So if we were to compare all three of these approaches, well, what would we see? Number one, usually the results are pretty consistent, pretty similar. And also the most commonly used approach is CAPM. And that's why we had also spent some extra time on the CAPM model, because this is one that is widely used in finance. So one thing to kind of just mention is that, when we're talking about issuing new common stock, then there is a significant flotation cost involved. And as you can imagine, there are banks involved and they have to, sort of float the stock, all of that. So that's a little bit of expensive endeavor. And so usually companies, as I kind of mentioned a little earlier, they don't issue new stock very often, but when they do, then they use this particular formula that really takes into account, the flotation cost, right? So, so that is basically something to sort of mention over here. And this right here, this value over here in the denominator, this is different. So it's basically the same formula. It's the RS formula, but here you can see this 1 minus F is also added. So this is basically the net price per share received in percentage terms, right? So we're kind of taking out the flotation cost from the whole equation, right? So we're accounting for that. And this F right over here is the net price per share received in percentage terms. So just something for you to remember. So it's the same as RS, except we are taking the net price per share received in percentage terms, and we're adding that over here. Okay. Now, bringing all of everything that we've learned so far in this chapter together, we then, once we put it all together in one formula, we are able to calculate the weighted average cost of capital. So right in the beginning, we learned, how to calculate the rate, the RD. We also learned how to calculate the return on preferred stock, how to calculate the return on common stock, right? So these are things that we kind of learned. When we put it all together, and also we remember as far as the return on debt, we have to sort of use the after-tax value of that. And for our purposes, you can just ignore this. I really didn't go into it. So we have one component, two component, and three component. The first one is the debt, second is preferred stock, and the third is the common stock. Now we also see this W values over here, and this is basically the weightage, the weight of each one of these, components. So once the weights should be based on the company's target capital structure. Now the WACC is the current weighted average cost the company would face for new or marginal dollar of capital. So again, this is if you are going out into the market, you need to get some more money for some project, maybe some expansion, then what is the average cost of capital that you would be charged if you went out to the market? There are certain factors that a firm cannot control. And that is the level of interest rates in the market, the market risk premium. This is basically market risk premiums occur because generally investors are risk averse, right? People don't like risk. And also, firms cannot control the tax rates. But there are certain things on the other hand that firms can control. And this includes the capital structure policy, the dividend policy, and the investment policies. Now I'm going to talk to you just a little bit about adjusting the cost of capital for risk. There are sometimes, you are basically trying to figure out, the entire, let's say there's one particular division that is about to expand. And so you're not really looking at the company expanding, you're really looking at a division that's going to be expanding. In that case, you want to sort of find a beta that is a divisional based beta. Right, so because you're not really looking at the beta for the entire company, but you're trying to find the beta of a particular division in the company. So there are two methods to do this. Number one is a pure play method, and you basically find a similar single product company. So let's say you are planning to grow your agricultural business, maybe pesticide business, then you would look at, a single product, a company that is just making pesticides, and you'd be able to sort of look at their betas to get an idea. And another method is the accounting beta method. And here you basically run a regression of divisions accounting returns on assets against average return on assets for a large sample of companies. So basically you run a regression of divisions accounting return on assets against the average return on assets for large sample of companies. And so you're trying to sort of use regression to sort of figure out, the divisional beta. Now, estimating the cost of capital for individual projects. So if you are planning to sort of estimate the cost of capital for one individual project, there are several approaches to doing this. Number one is you can use the standalone risk method. Here, the variability of, yes, as I was just mentioning, for individual projects, you need to understand a couple of things. Number one, that there are going to be standalone risks, right? There is going to be how, the expected return of the project, there's going to be some variation in that. And the second thing is you need to remember that, there's going to be some risk that can be diversified away, and then there's going to be some risk that you cannot diversify away. The market or beta risk is also, that's another thing you need to keep in mind, is risk as seen by well-diversified stockholders. Fine. So you will just, you need to sort of use risk-adjusted cost of capital. And so those are just some things to really keep in mind. And let's see. Okay. And that kind of brings us towards the end of this chapter. And, a couple of things for you to really focus on is to do a lot of practice on calculating back. And again, you will, the practice problems, I'll be assigning them. So the more practice you do, the more familiar you'll be and the more comfortable you'll get with using all of these new formulas that I have kind of introduced to you. And that is pretty much it. With that, I come to an end of this chapter. Thank you very much for your time. I hope you enjoyed learning all these new things about calculating the weighted average cost of capital. Take good care.